I will kick things off with the Moonwell Minute. So the first metric I wanted to look at this month, and please let me know if you have any issues with audio. So the first metric I wanted to look at was voter turnout. I feel like a broken record saying this, but month after month we've had just insane records here with voter turnout. So the previous one was in, let's see, October to November. We had MIP B36, which got 388 votes, and that was the previous record. In December, the first proposal for the month, which was MIP X08, this one ended up getting 620 votes, which was just mind blowing with the voter turnout we've had on that one. Yeah, that's great to see. I think the overall trend that we're seeing with these like intra-month voter turnout is that people really are showing up on the as soon as possible in the month, and that's to meet the requirement that was established by MIP X05. Essentially requiring people to vote once to claim their rewards for the month. So yeah, that's kind of the trend that we're seeing. Yeah, so that's the first main thing. The second thing I wanted to highlight was the Nakamoto coefficient. Earlier in the month, it was at 6 delegates. Again, this is just the number of delegates required to reach half or 50% of the total voting power. This last month, it was at 6, and in the past month, it's decreased to 5, which it's not a huge deal. I just kind of wanted to point it out, and that's pretty normal for the end of year activity that we usually see. So nothing to be alarmed by. Basically, it just means that the voting power is being consolidated a bit. And yeah, that's the Moonwell Minute. Just a couple of metrics I wanted to point out. The main agenda for the call today, we are going to first throw it over to Ethan at Threshold Network. He is the tBTC lead. You can correct me if I'm wrong on that. So I'll go ahead and let you take it over whenever you're ready.
Yeah, thanks, Alex. Hey guys, as you can see, I'm the tBTC growth lead for Threshold Network. So my role is to basically just try to get tBTC in all the cool places. Of course, Moonwell being one of them. So you can see, like, we've just put in a proposal to have tBTC on the base market, and super excited, very pleasantly surprised by the turnout. I mean, 430% quorum, which is pretty insane, with 43 million votes for and none against at the moment. But yeah, that's super exciting for us. Moonwell's definitely been on our list. We've only recently had like such a large spike in TVL on base and looking to continue that. Bit of like an alpha leak, but we do have direct minting coming to base very soon. So rather than having to take like your Bitcoin and then deposit and then bridge it to Ethereum and then bridge it over to Base or doing it via Coinbase, you'll just be able to connect your BTC wallet and then mint directly on Base. So yeah, we're all about decentralization. We're not looking to kind of compete with like the Lombard guys on points or any of that. We're just trying to give you guys the most decentralized and trusted access to Bitcoin in the ecosystem and allow you guys to get a yield on it. So that's what we're here for. We obviously want to give you guys as much choice as possible. You have CBBTC there on base and then WBTC on Optimism as well. So we're obviously a choice for you guys to use if you want to increase your decentralization and reduce your exposure to centralized entities. Yeah, that's what we're doing. Super excited to get on Moonwell. We're also ramping up our presence on Optimism as well. Hopefully you'll see us here again soon in maybe a month or two. We may be bringing direct minting there as well, and then we can bring a tBTC market to Moonwell on Optimism as well.
All right. Sorry, Darren, if you want to raise your hand, I'll go ahead and get you up.
So I recently put up a proposal to list USDS on the core markets. Now, I think that this is a pretty great opportunity for Moonwell, especially since Sky Protocol / Maker recently launched 100 million in liquidity on Base, and so there may be some concerns that it's not really that's all centralized in the wallet that bridge those funds over, but I expect that to change pretty rapidly. And so I think that this is a pretty great opportunity for Moonwell, and yeah, hoping the community sees the opportunity in front of itself. And feel free to leave any comments or questions in the thread, or if you have any questions about the asset listing itself, feel free to reach out to me. But yeah, just keeping it succinct for today. Thank you.
Hey, Darren. This is Luke. Thanks for the proposal. I just wanted to share a little bit more info and context about Sky Money and MakerDAO and what their plans are, just so you're aware, everyone that's listening to the call. First of all, we met with the MakerDAO BD guy, and they have really big plans to expand across layer 2s, including the superchain. And they also recently expanded to Solana. You might recall they achieved, I think, something like 250 million in TVL on Solana really rapidly. So while MakerDAO traditionally has just stuck to mainnet, the DAI stablecoin has been around for many years. It's one of the best algorithmic stablecoins or CDP-backed stablecoins on mainnet. With the Sky Money and the new USDS stablecoin, they really want to expand beyond just mainnet Ethereum and go across the superchain. So I just wanted to let everyone know about what MakerDAO's plans are, or I guess it's now called Sky Money. It's the same organization, just with a new name. What we've learned is that they want to enable people to natively mint USDS on base, so it doesn't just have to be bridged. And if you're familiar with the way MakerDAO works, you typically create what's called the CDP, or collateralized debt position, where you put your, Bitcoin or Ethereum into a smart contract that is yours alone, and then you can mint USDS or DAI from that collateralized debt position. And then this gives, on mainnet, this was a really popular thing to do for 5+ years or so, because early Ethereum, whales could basically mint a stablecoin, and then, you could even go shopping in the real world with it. But its use in DeFi has really been key to the success on Ethereum mainnet, and they hope to repeat this success on layer 2s like Base and Optimism. And so what we also learned is that Sky Money is going to have a program for money markets like Moonwell, the Moonwells and Aves and Compounds, and all the money markets of the world, the Morphos, et cetera, to basically offer very close to the USDS savings rate to anyone that supplies it on Moonwell or on a money market. So today, if you stake your USDS and the USDS savings rate contract, you get paid 6.5% on mainnet. They're going to offer to protocols like Moonwell 6.4%. So it's just 0.1% lower than that, to simply supply it as a collateral asset on Moonwell. And so the benefit you would get, or we will get as a community, if we're able to safely launch USDS, is that we'll be able to supply USDS as collateral, and you'll earn a normal supply APY like you would on any other collateral asset on Moonwell. You'll also earn 6.4% in USDS tokens that will be granted to Moonwell, and then we'll have to distribute those through the automated reward or liquidity incentive governance proposals. And then in addition to that, you can borrow against the USDS. So for advanced farmers and other strategies, you'll have the ability to use USDS as collateral instead of just having it sit idle in the savings contract. So I think this is a really nice collateral asset for us to consider launching because of all the benefits it could bring to the ecosystem. And I know that many of the people that are deep into DeFi that would like to maybe supply liquidity on Aerodrome would love to borrow against USDS and farm some of those really nice LP positions on Aerodrome, for example, or do other more advanced strategies like hedging and things like that. So just wanted to give people context about what MakerDAO and Sky Money's plans are for the base ecosystem. And I think it's a really great opportunity for Moonwell to potentially be the first big ecosystem that has USDS. To that end, I've actually voted for a USDS USDC pool on Aerodrome with 3% of the Moonwell Aero relayer. And so if you do have USDC or USDS and you want to LP in that DEX market, that will help boost DEX liquidity so that the market will be safer as Gauntlet does their risk analysis of the market to prepare for potentially putting an on-chain proposal up. So just wanted to share all that context. I know that's a lot of information to unpack. Happy to answer questions if you guys have any in the chat. Thanks.
Thank you, Luke. DeFi Nicola with Block Analitica. If you want to raise your hand, I can get you on the stage. There we go. We'll get you.
Great, thanks. First of all, thanks for the invite. Thanks for inviting me. I'm DeFi Nicola, and I'm coming from Block Analytica team. We're basically doing the risk curation part on the Morpho vaults on Morpho-based deployment. So basically the isolated markets from the perspective of the Moonwell UI. And here today I just wanted to give a brief overview of, first of all, of months of recaps of the October and November. The December recap is still in the works and should be soon on the Moonwell forum as well. In the October recap, we released the updated reallocation strategy, which basically the new model is optimized, of course, for yield, but alongside that is also making sure that the looping strategies such as leverage staking strategy, including all LSTs available on Base on Morpho, are profitable and stay profitable. And while on the other hand, it also accounts for external borrow rate benchmarks across the DeFi, basically not to have the lower borrow rates lower than the benchmarks, and so we don't lose the deposits in the vaults, and not to have those higher than the average, so the borrowers would close their positions. Yeah, so I think it's worth mentioning that a couple of weeks before the US election, so around start of November, we kind of saw a significant increase in borrowing demand, which also, of course, resulted in attracting more TVL for our vaults. At that time, those were ETH, USDC, and EURC vaults. Now we also have the newest one, the Coinbase BTC vault, and combined TVL at the moment of speaking is around 170 million. And yeah, now basically the second topic I wanted to talk about is the Coinbase BTC vault itself and the upcoming markets and the one that are available for people that want to earn a yield on the Coinbase BTC. So the available market right now is the Lombard BTC market, but the Pendle PT tokens. PT Lombard BTC market, with the expiry date being in May 2025. Now this is an interesting one, and as you have basically a fixed yielding collateral, and you can borrow the Coinbase BTC liquidity available from our vault. Now, I think the most important topic around that PT LBTC market is the Oracle. So we kind of decided to go with the recently implemented Price Oracle by Pendle team, which has been in use on mainnet actually for the vault that SparkDAO is using for a slightly different purpose. The underlying asset is different, so it's the Ethenas SUSDE, but in our case it's the Lombard BTC. So basically it's a new Price Oracle mechanism that allows for pricing PT tokens, Pendle PT tokens, at a discount based on a fixed yield to maturity, which allows for more accurate pricing for long maturity PTs instead of using the simple fixed redemption price. And because this does not rely on AMM TWAP pricing data, the new Oracle can basically work without increasing the risk of liquidation cascades or any kind of market manipulation. And yeah, this, as I said, is already implemented, so the market is live, and I think we already have some decent borrowing demand. And the second market we plan to onboard to the Coinbase BTC Vault is the pure LBTC market, and this one we have recently, like half an hour ago, posted the full risk assessment of the LBTC collateral as well. So this one also has a Oracle that basically is developed by the Moonwell DAO contributors, and it basically combines the Redstone proof of reserve feed with the Chainlink LBTC market feed, and basically the market rate is acting as a fallback if the Redstone's proof of reserve feed returns some value that is out of the predefined range. And you can basically read more about the assessment of and how we got to the target range, the range we are targeting at the market launch, market creation. Of course, we also suggested for this Oracle to be upgradable and controlled by Moonwell, so we can later, if deemed necessary, either adjust this range that is basically acting as a trigger for the fallback if the market conditions, of course, change, and if, for example, the Lombard, the LBTC starts generating some yield, because as of now it's not generating any. The redstone proof of reserve feed is sort of kept to 1. So yeah, we want this to be adjustable in the future and to have that kind of control. Feel free to ask any questions if you have, whether about the markets onboarded to our vaults, on our vaults, or about our vaults themselves. Thanks.
Thanks, Steve.
Okay.
Nicola. Hey, I have a question for you. I know recently there were some people that were interested in increasing the supply caps or the flow caps to the LBTC market. And I was curious, I think you mentioned that they had been increased recently. I guess my question is, has there been pretty heavy borrowing demand in that Pendle LBTC market?
Yeah, the borrowing demand has been increasing since the market creation, and I think it will continue to increase as we are, as I said, trying to keep the borrow rate lower than the yield available on Pendle, the principal token yield, so the fixed yield. And regarding the caps, the supply cap for the market, yes, we submitted the transaction for increasing the cap to 200 Coinbase BTC. As some may know, we have a 4-day time lock which is needed to pass in order for this to be executed.
That makes sense. It may not be past the time lock yet. Okay, so I just have another comment to make about these 2 new market ads. First of all, thanks for your hard work on the Block Analitica team. I really appreciate the expertise you put into the automation. I think you're one of the only, if not the only, risk curator that is automating risk management in this way, and that allows us to be safer as a community and have some of the safest vaults available. So I want to thank you and the team for all that hard work. I wanted to mention just why these new markets are really strategic for Moonwell. So first of all, this Frontier CBBTC vault, Frontier Coinbase Bitcoin vault is different than the flagship vaults. As you might recall, Frontier represents that it is a more moderate risk profile than the flagship vaults, which are a very conservative risk profile. Now, the reason why we think this is very strategic for the base ecosystem in particular is because if you recall, last year on mainnet Ethereum mostly, EigenLayer added about $30 billion of TVL to Ethereum. That primarily happened on mainnet because EigenLayer wasn't really well established on the layer 2s yet. It's starting to change with protocols like EtherFi and KelpDAO launching markets on Moonwell recently. And now there's a lot of smaller accounts that are actually restaking Ethereum. So Babylon, which is the restaking protocol on Bitcoin mainnet, is now just starting to take off. And if Ethereum added $30 billion of TVL to mainnet, it's very likely that Babylon could add potentially hundreds of billions of TVL to mainnet as well as to other layer 2s. And if any of you are interested in learning more about this, I would encourage you to read the Electric Capital report that just came out a few weeks ago, because they talk about this and how they're seeing a lot more activity with newer protocols like Lombard, which stake into Babylon or restake Bitcoin into Babylon on Base and other layer 2s because the fees are so low compared to mainnet. So whereas on mainnet you have a few large EigenLayer whales, on Base and other layer 2s, they're seeing many thousands of smaller Bitcoin restakers that are using Lombard to restake into Babylon. And so these markets are really attractive for people that want to earn high yield on Bitcoin, although they do represent more risk than just simply holding Bitcoin spot, simply because you're taking the restaking risk of a new protocol on Bitcoin mainnet that is Babylon. So Lombard is a really solid team. I've met a few of the members of the team. There's some former Coinbase people there, and there's some people from Polychain, which is one of the earliest venture capital investors in the space. And these 2 markets actually represent a really interesting dynamic. I don't want to take too much time from the call, Alex, but I just want to mention first Pendle, because of the fact that Pendle recently launched on Base, they offer a way for you to basically get your yield up front by selling your yield token. And then you can simply borrow against your Pendle token. And over time, the Pendle token will, in May of 2025, will mature and it will be worth one Bitcoin when it matures for 1 Pendle token, or principal token, if you will. And so that's a really nice, attractive thing for borrowers on Morpho, because if the rate of maturity is higher than your borrowing interest, then you don't have to worry about maintaining your loan as much and adding more collateral as your interests accrues. So it's a really nice, kind of set it and forget it system for Pendle LBTC holders. And then the Lombard BTC market, it doesn't have the Pendle characteristics, but I was part of the design process with Solidity Labs, and I think they've really developed a really innovative Oracle system or price feed system that's going to allow the LBTC market launched by Block Analitica to be safer than the other LBTC markets. Nicola did mention this briefly, but basically there's a Redstone proof of reserves feed that tracks the actual Bitcoin that's restaked into Babylon. And it tracks the actual wallets that Lombard uses to restake that Bitcoin. So if that Bitcoin is ever lost, that proof of reserves feed will drop below 1. Or as they start to earn restaking yield over time when ADSs come online, that rate will rise above 1. And so that's a really nice proof of reserves. But if there was market volatility, or if the proof of reserves feed dropped below 1 because some Bitcoin was lost, then the price feed actually falls back to the Chainlink market rate feed, with hopes that liquidators would clear bad debt or clear positions off of the Moonwell protocol and the Morpho protocol before bad debt accrued to the vault. So I know that's a lot to unpack, but I just wanted to share some details about those two markets. They're really innovative, and I think this represents a new step for the Moonwell community to kind of have a more moderate risk vault, the Frontier Coinbase Bitcoin vault. And so I'd love to hear your feedback, and I think in the community would probably love to hear if people are interested in more moderate risk profile Ethereum vaults or stablecoin vaults in the future. Thanks for letting me talk so long, Alex. Apologies for the long-winded conversation.
No, thanks, Luke. It's always great to hear your input. So take up as much time as you need. And speaking of Lombard, actually, Maxim, you can go ahead and talk about the LBTC proposal.
Hey, hi. So, well, first of all, thank you, Luke. You've given already quite an extensive overview, I believe. So yeah, definitely appreciate working with the team so far. Happy to see the proposal actually passed, and having the implementation of the oracle that you guys have is pretty interesting. I've seen before, nobody really was proposing anything similar. I guess Gearbox were looking into a similar scenario, similar kind of setup with the combination of proof of reserve and the market rate. But yeah, eventually I think you guys will be the first to implement it. So kudos on that. It's definitely an interesting way to approach risks here. So yeah, definitely happy to work in that setup with the LBTC market. And yeah, so just a couple quick words on LBTC. So LBTC is a liquid stake token. The underlying native Bitcoin is staked into Babylon, as Babylon is continuously opening new caps for the deposits into the protocol, similar to what you have seen previously with EigenLayer. There is always some amount of BTC that's not exactly staked into Babylon, as we keep on accepting deposits above what is actually allowed by Babylon to be staked. And as we approach to be the #1 staker into Babylon, it actually works very well for us in terms of scaling. So for those who actually worry about maximizing your Babylon exposure in terms of Babylon points, I very much encourage you guys to focus on the bigger LSTs or the smaller ones, just simply because they're a bit more scalable. It's always much harder to X dilute a 1.5 billion protocol than $500 million protocol. And on that note of points maximization for the Babylon side, I'm also happy to say that Lombard was the biggest staker into the first 300 blocks of the latest Cap 3 of Babylon, which the first 300 blocks were actually incentivized with, if I'm not mistaken, a 4x additional multiplier on top of whatever is staked into that block. Lombard, over the course of roughly 500 blocks, which is like a couple of days, we 2x'd our total Babylon points exposure. So we're comfortably sitting at least 50% above the average points to the Bitcoin holding ratio. So again, if you want to maximize Babylon points, that's definitely an important metric to consider. And yeah, if we go deeper into the proposal, basically, the idea is pretty straightforward. We have this liquid staked yield bearing asset, which allows you to take this to maintain your Bitcoin exposure while in the meantime, still accruing some yield on top of that. So a very logical next step for us was to follow what we have seen with the W staked ETH. Essentially, we did realize that LBTC is probably the best collateral, Bitcoin collateral in the space. That's how we came up to the conclusion that first, we would love to borrow other Bitcoin packed assets. And as we scaled into the base ecosystem, obviously the biggest Bitcoin asset on base is tBTC, and Moonwell fortunately has a ton of it. And historically, it's been true that tBTC has never been really borrowed. And if you look into other packed assets with their broader history, it was true as well. So normally your Bitcoin packed assets earn you like couple basis points per year. And this is considered normal because they're not usually seen as a debt asset. They're usually seen as collateral asset just to borrow your stable coins. So now with the LBTC, it actually starts to make sense to borrow Bitcoin packed assets. And this is basically the core of this proposal. Let the LBTC holders leverage their LBTC exposure by borrowing tBTC. What this will eventually do to the Moonwell markets is producing quite a substantial, especially relatively speaking, yield for the tBTC lenders. And this will further incentivize people to bring their tBTC as collateral to Moonwell platform to keep on borrowing other assets whitelisted within the core markets. So yeah, the TLDR would be LBTC has definitely everything in place to be able to borrow hundreds of millions in packed assets. So far, it has been really tough because we haven't had a great access to the market, to the lending market, which has a lot of packed Bitcoin assets already on board. But Moonwell is probably the first actually above a certain threshold market, which is actually sizable enough to accommodate tens and hundreds of millions of LBTC in collateral. So I have a strong degree of confidence that the majority of tBTC on Moonwell will soon be borrowed by LBTC collateral.
That is awesome, Maxim. That's kind of my thesis as well. Yeah, I just wanted to say really quickly, we saw a very similar thing happen with EtherFi last year on mainnet, right? Where once EtherFi became a collateral asset, then all of a sudden that drove heavy borrowing demand for ETH. And I do believe also that once LBTC becomes a collateral asset on the money markets like Morpho and Moonwell, then we'll see heavy Coinbase Bitcoin borrowing demand. And it will be great for people that just want to single-sided supply their Coinbase Bitcoin and earn a decent yield. And it will also be great for the people that want to loop their or do leverage strategies for points as well. So excited to kind of be a part of this ecosystem with you.
Yeah, 100%. And there is also obviously an additional aspect to this. If you think of a very traditional use case of Bitcoin packed assets used as collateral to borrow stablecoins, well, in some sense, LBTC is by no means worse or even actually a better asset to do that. And we definitely see the crazy funding rates on perpetual exchanges, which actually guys like Athena benefit heavily from. All of these rates, they are brought to the ecosystems, and people can use their stablecoins to benefit from that. So again, if you want to maintain your Bitcoin exposure, but at the same time you want to benefit from those crazy funding rates on Bitcoin, Ethereum markets, you can still do that again while using your LBTC, maintaining your Babylon Lombard exposure. At the same time, you would be able to do this carry trade. Please be conscious also that the carry trade is very, very popular. So the borrowing rates and stable coins are usually insane.
All right, Andrew, if you're here, go ahead and get on to the Gauntlet recommendations, and I'll stop talking.
Thanks, Alex. Hey guys, Andrew standing in for Sai today from Gauntlet. I'll be presenting our latest risk recs, interest rate updates, and cap changes for the month of December. I've got quite a list here, so I'll try to be succinct, but let's go ahead and get started with base. We recommended to continue to walk down USDBC params to align with the protocol strategy to favor native USDC. We continue to see reducing liquidity, on base for USDBC. So supply and borrow caps along with collateral factors have been reduced to help avoid exposure to an asset with diminishing user demand and liquidity. As far as WeETH, Gauntlet recommended a collateral factor increase from 74 to 78%. Simulations show a very healthy supply and borrow distribution for WeETH. And increasing the CF improves capital efficiency for both suppliers and borrowers while staying within some safe risk thresholds. So glad to see some increases there. We had some interest rate parameter adjustments for stablecoins on base, USDC and EURC. We recommended a modest 50% or 50 basis point increase to align with market conditions, mainly noting that the Sky savings rate was recently moved to 12.5%. So we want to keep borrow APRs competitive while maintaining enough liquidity to attract depositors. And avoiding a very significant increase allows us to stay fairly responsive to the market trends and evolving market conditions while still balancing borrowing demand with healthy utilization. So excited to see that. Moving over to tBTC, we had some recommendations on the IR curve regarding the kink, multiplier, and jump multiplier. Utilization for tBTC has been declining a bit, indicating recently low borrowing demand. Reducing both the borrow APR and the kink is intended to encourage borrowing and improve utilization. Lowering the APR from 4% to about 1.5% effectively at the kink makes tBTC more attractive and helps stimulate that demand. So excited to see how that works and see if that will drive a higher borrowing demand. But yeah, moving over to a quick note on RETH. We didn't have any parameter changes for RETH this month. We were looking at liquidity on chain, and it looks like it's substantially increasing in DEX TVL. I saw something like 2.6 million go to about 4.6 million, and that may have recently changed with the market conditions, but we'll continue to monitor on-chain liquidity conditions and see if user demand, is there, and we'll drive further recommendations for that. So that's wrapping up December Rex for base. Moving over to Optimism, we did have similar interest rate parameter adjustments for USDC, USDT, and DAI, mainly on the kink, multiplier, and jump multiplier, mirroring the base recommendations by adding 50 basis points at the kink to align with market demand for stablecoin borrowing. So aimed at maintaining a healthy utilization and rate stability while being aligned with what we recommended on base. Regarding wrapped BTC, we increased the reserve factor to 100% and are looking at reducing our exposure to wrapped BTC for the protocol. Collateral factor was moved from 50 to 10%, and we also significantly reduced the supply and borrow caps to remove the systemic risk associated with wrapped BTC and Optimism. I think that's a good position for the protocol to take, and we're excited to see that reduced risk because no one really knows what's going to happen with wrapped BTC. So we looked at all the positions that currently held wrapped BTC on Optimism, and there were no risk for immediate liquidation. So it was good to see that the recommendations would affect user positions. Moving over to WETH, we increased our supply cap from 10,000 to 12,000. We looked at the top positions that were holding ETH or using ETH on Moonwell and Optimism, and 7 of the top 10 positions are recursive. The rest are either supply only or borrow only USDC against WETH. So we, increasing the cap here allows for more user participation without overly raising risk. I just wanted to point that out. And then we had some supply and borrow cap increases for CB ETH, wrapped RS ETH, and VLO. The VLO was pretty significant. We moved from 25 million supply cap to 35 million supply cap, and we had the borrow cap move from 8 million to 10 million. There's been a lot of user demand and for VLO on chain. We're going to continue to monitor it and see how things progress. But I think the other day I was looking at the supply VLO, and it was continued to increase. I think I saw something like 30 million the other day. So we'll have to monitor that and see if there are any other demand increases or that warrant updating. Okay, moving over to Moonbeam, we have some collateral factors increases for some of the wormhole assets. USDC, WETH, and wrapped Bitcoin .WH all had changes here. They went from 42 to 39, 38 to 33, and 15 to 14 respectively. So small decreases there to reduce potential insolvency risks tied to bridging liquidity. We also had some reserve factor changes for XC Dot and Wrapped Glimmer, 35 to 50%. We saw that the notional supply of these assets have grown faster than the available DEX liquidity. So increasing reserve factors here accomplishes two goals. One, it builds reserves to safeguard against potential insolvencies, and then it also lowers effective supply APRs, thereby, reducing over exposure to these assets in the market. So it's reduction, I think, makes a lot of sense, but of course, we're open to feedback from the community. Feel free to weigh in on the forum. We didn't have any changes for Moonriver in December. The market, remains stable, and risk and efficiency seems to be, at a current healthy balance. So I think that wraps up all of the December changes and recommendations for the month of December. If you guys have any feedback, please feel free to drop in the community, forum posts, and we will, of course, respond. But I think that's everything from my end.
All right. Thank you, Andrew. I think no one's talking right now. Again, I can't hear anybody. So before we wrap, if anyone wants to jump in, I can't hear you, but I'll stop talking if I hear or if I see somebody speaking. Yeah, great to have you on for the first time, Andrew. Really appreciate it. And yeah, again, a huge thank you to all the guests for giving us an hour of your time. To the community, leave feedback on those props. Also, make sure you turn out to vote on them, of course. And we will be back to our usual schedule of the first Thursday of every month going forward. I think the next one is February 6th. And all right, that's going to be it. That's all I have for you today. Thanks, guys. Cheers. Thanks for rolling with the punches. I appreciate it.